Hello students and welcome to the lecture. So students, as we know that we are covering the financial knowledge and the banking awareness part of it, and basically what we are discussing over the FMC, Forward Market Commission. Okay, so far we have discussed the various facts and figures in the topic, and also we have revised some tidbits of the Forward Market Commission. All right, so right now if we move forward, so this is the topic we are covering. Okay, we have finished the FMC definition, we have done with the regulation, we have done with the functions, we have also done with the commodity future market in the previous lecture. Now what we are left with, the Forward Contract Act, integration with SEBI, commodity derivatives, and the summary part. Okay, so let's start. So this is the topic we are going to start with. Forward Contracts Regulation Act 1952. Okay, so please remember in the previous lecture also what I told you that if we talk about the FMC, or you can say as far as the FMC is concerned, basically its parent act was Forward Contracts Regulation Act 1952, right? That's what we have discussed. Okay, so here also we are going to start with the discussion on this part. So let's start. So first what we are going to see the overview. The Forward Contracts Regulation Act 1952, in short known as the FCRA, is a significant piece of legislation in India that provides a legal framework for regulating forward contracts and the future trading in the country. Okay, so basically when we talk about the forward contracts and the future trading in the country, it comes under the supervision of FMC, Forward Market Commission. That's what we have discussed. Okay, and the Forward Market Commission is a statutory body. And if this is a statutory body, it means that it is deriving its power, the functions from the, you can say, from some legal source. Okay, so the legal framework for this is that one. Okay, Forward Contracts Regulation Act 1952. Okay, so let's start. First is the historical part, or historical context, you can say. Okay, the FCRA was enacted in the year of 1952. Remember this thing, to regulate and govern forward contracts and the future trading, recognizing the importance of these financial instruments in the Indian economy. Okay, might be in the previous lecture and also previous to previous lecture I had told you, support there are two companies, XYZ and the ABC. All right, similar to them there are various companies and the traders who are getting indulged in the future market. All right, and because these are important in terms of the economy and all, so that's why it's become very important to make sure that the financial instruments, okay, these financial instruments must be adhere some importance in the field. Okay, so please remember this thing. Thereafter it was introduced to provide a legal framework for ensuring fair and transparent trading practices and to protect the interest of various market participants, sometimes from the buyer side, sometimes from the consumer side. Okay, and this should require a fair and transparent trading practices. It means every terms and conditions must be presented on the thing. Okay, as I have told you in the previous lecture that these are the standardized contracts. All right, so keep this thing in your mind. Now we move forward. So first is the definition of forward contracts and the future contracts. We have to look at this. Okay, so the FCRA defines what constitutes forward contracts and the future contracts. So far, what we have taken an example to understand the concept. But right now, what we are going to do, we are going to look at the proper definitions which are mentioning as per the FCRA 1952. It also distinguishes between the two types of contracts based on the factors like the delivery of an item, like the standardization and the regulatory oversight. Okay, it means intrastate or interstate. Do you okay, let me explain to you. What do you mean by the intrastate? Or what do you mean by the interstate? Okay, so basically, intrastate means within the state. Or second, interstate means outside the state. Okay, so let's take an example. Suppose this is the state A. Okay, and now we having two people or two parties. One is the producer, second is the buyer. Okay, so if we go by this situation, you can see the producer has to deliver the product within the state. Okay, so this is the condition of within the state. So it is a intrastate condition. Why? As I have told you, when we talk about the within the state, so it is a intrastate condition. Okay, because both of them are presenting into the same state. Similar thing is that suppose, okay, let me make it again. Here is one state A, second state B. Okay, this is and this is the producer, this is the buyer. Okay, so if we go by this time, then what we will see the producer will supply the goods and services to the buyer, which is located in the state B, while the producer is in the state A. So it is a outside the state, or you can say between the state. Okay, so this is the condition of interstate. Got it? So this is the conditions. Okay, so why I have told you, first for your knowledge, second for the regulatory oversight. How? Suppose, as I have told you in the previous lecture, that FMC also has to maintain a coordination with the other government agencies. Okay, so when we talk about this one, it is a within the state, so it means only one state trading authority is required to maintain a communication with the FMC. All right, but when we talk about one or two states, so it means several states authorities are required to establish the contract with the FMC or coordination with the FMC, you can say. Okay, so that's give the regulatory oversight. All right, now let's move forward. Thereafter, forward contracts are typically private agreements where parties agree to buy or sell a specific quantity of commodity or financial instrument at a predetermined price on a future date. Okay, so you can say These are the private agreements because it is signed between the parties. Details are generally not disclosed to the people. Okay, they are agreed to buy a specific quantity of a commodity, as I have told you, or a financial instrument at a predetermined price. Like in the previous example, XYZ and the ABC are agreed on the 50 units at the fixed price of 50,000. All right. Second is, they are generally not standardized and may not have the same level of regulatory oversight. Okay, it means suppose if there are various parties A, B, C, D, E, F, F, G, H, I, J, K, L, so many parties are there. Okay, so this is not necessary that all these parties are required to obtain a single standardization process. Okay, this is not a compulsory situation, you can say. All right, and second, they might be interstate, they might be intrastate, so same regulatory oversight is also not possible in these cases. Okay, thereafter, future contracts on the other hand are standardized contracts traded on recognized exchanges. They involve the obligation to buy or sell a standardized quantity of a commodity or financial instrument at a predetermined price on a specific future dates. Okay, second thing we can say, future contracts. When we talk about the future contracts, are standardized contracts traded on a recognized exchanges. Okay, involve the obligation to buy or sell a standardized quantity of a commodity or financial instrument at a predetermined price of a specified future date. As we have discussed, XYZ 2005 signed with a deal of ABC, 2006 to be delivered of, okay, 50 units at rupees 50,000. It means rupees 25 lakhs is to be paid off, or the predetermined price. Quantity is 50, price is 25 lakhs. Okay, none of them could be able to deny buying or selling. Okay, because it's having the legal force obtained from which? Obtained from future agreement, or you can say future contract. All right, so this is the part. Now, these contracts are subjected to greater regulatory oversight and are designed to ensure the market transparency. And the regulatory oversight is basically done by FMC. All right. The FCRA empowers the government to recognize specific association or exchanges that operate commodity and future market. Okay, it means that whether you could participate individually or you could take the help of specific association or exchanges as a third party. You can say, suppose ABC, XYZ. First case is that they are directly involved with each other. Okay. Second case is ABC, XYZ. Now they have DEF in between. Okay. So ABC and this. All right. So this is a third party or the specific exchange or association. In such a case, they having the private partnership. In such a case, they also having the private partnership. But right now, they both are communicating directly. But in the second case, they having the mediator in them. Okay. So the FCRA empowers the government to provide the recognition to these kind of mediator, specific association or exchanges. All right. Now let's move forward. These recognized exchanges are subject to the regulatory framework outlined in the Act. All right. To gain recognition, exchanges must meet certain criteria and adhere to the rules and regulations prescribed by the Forward Contracts Regulation Rules 19, okay, corrected 52. Okay, 1954. It's not an act, but it's having the rules. All right. So like you can say, it's a process of licensing. Okay. In the previous lectures, also I had told you the thing. If the particular organization is claiming that it has been recognized by the appropriate authority in that particular field, it means that this organization must having the license as the recognition proof, right? So basically the recognition is like a license granting. Okay, and for this the particular exchange which is which is aspiring to be obtaining the license or to be recognized by the government is required to meet the certain criteria and adhere to the rules and regulations prescribed by the Forward Contracts Regulation Rules 1954. Powers and functions of the regulators. The FCRA delineates the powers and functions of the regulators, which include the regulation of contracts, the setting of margin requirements, and the surveillance of trading activities. Okay, so remember the regulations are like the setting of margin requirements and the surveillance of the trading activities. The regulators, often bodies like the Forward Market Commission (FMCs), oversee the operation of recognized commodity exchange, ensuring they comply with the law and follow regulations for fair and transparent trading. Okay, like you can say, those who getting the recognition or the license for the government funds are not allowed to do whatever they want to do after they are obtaining the license. But the FMC is, you can say, organizes the general inspections and the, okay, let me write down again in the proper manner. It's like general inspections and you can say supervision. All right, to check out whether these are doing well or not, or you can say whether they are showing their compliance with the law and follow the regulations for fair and transparent trading or not. All right. Thereafter, we have the prevention of unfair trading practices. The FCRA includes provisions to prevent unfair trading practices, market manipulation, and price rigging. This is vital for maintaining market integration and protecting the interests of the market participants. All right. Thereafter, we have the Act also outlines procedures for the settlement and delivery of commodities of financial instruments under future contracts. These procedures help ensuring that the contracts are honored and executed correctly. Thereafter, what we have the dispute resolution programs. FCRA provides mechanism for dispute resolution between parties engaged in future contracts, including provision for arbitration and legal recourse in the case of disputes. The FCRA has undergone the several amendments over the years to adapt to changing market conditions and practices. As I had also told you in the starting, that FCRA is a part of the economy, and as the economy is dynamic, so it means the FCRA is also undergone several changes as per the requirements time to time. Okay, so you can say FCRA has undergone several amendments over the years to adapt to changing market conditions and practices. Amendments have aimed to strengthen the regulatory framework, improve the market transparency, and enhance the investors' protection. All right. So students, basically here we have finished with the Forward Contract Act also. In the next lecture, we will continue with the integration with SEBI, commodity derivatives and the summary part. Till then, just revise all the facts and figures we have discussed in this lecture and be ready for the another lecture. With this note, let's end this lecture and say thank you.